The Intelligent Investor by Benjamin Graham. Making money on the stock market has become the desire of so many people lately. Just look at the number of channels and profiles on social networks recommending stocks, day trading, and trying to convince you that it is possible to multiply your money in a short period of time. Now, the problem is that if you enter the stock market without a smart strategy, the opposite is likely to happen. You can lose a lot of money. Now, how do you manage to make a profit and avoid losses? Just being extremely smart is not enough. An example of this is the case of Sir Isaac Newton, one of the greatest geniuses in history. He invested in a South Sea Company stock and initially he made a profit. However, that initial profit turned later into a loss that would be more than $3 million today. And one could then say that to profit from stocks, it is necessary to be very lucky. However, luck is something that is out of our control. And we can find successful examples of those who use a specific knowledge to achieve results. This is the case of Warren Buffett. He's one of the richest men in the world, and he made his fortune investing in the stock market. And in his opinion, the best book to learn about investing is The Intelligent Investor by Benjamin Graham. So in today's Arata Academy summary, we'll understand why Warren Buffett says that and why this book, written back in the 1940s, remains on a bestseller list on finance to this day. And the reason for this is that it is packed with valuable content and an emphasis on fundamental and timeless principles. Please note, this is the summary of a book and not financial advice. Read the full disclaimer before proceeding. Understand the difference between price and value. This is how you analyze based on fundamental principles. The main idea behind the book, The Intelligent Investor, is to find out the real value of a company, and thus buy a share of that company at a price below the established value. This allows for a margin of safety. It increases your chance of earning a medium to long-term return when you sell that stock at a price well above what you bought for. The basic principle of a smart investment is to buy companies with good fundamentals at a discounted price. Anything other than that is pure speculation. Now, you can imagine that this is impossible, that the market automatically prices all companies on the stock exchange according to what they are actually worth. But not quite. Think, for example, when the coronavirus pandemic broke out in March 2020. From one day to the next, the prices of virtually every company on the stock market dropped a lot worldwide. It was a moment of panic in the market. Is it possible that these companies have lost ground at these levels overnight? Well, not really. You need to understand that price and value are two different concepts. Value is how much something is worth. Price is how much the market at any given time is willing to pay. And the price is subject to market fluctuation. Market prices bear little relation to company value, especially with stock exchanges full of speculators. The price of a share is determined by supply and demand. The value of a company is defined by the analysis of its fundamentals. It is in the difference between value and price that you can buy shares at discounted prices and thus multiply your money in the medium and long term, selling the same share at a much higher price when it is overvalued. The smart investor is a realist who buys from the pessimists and then sells to the optimists. How can you seek to be a realist and have an accurate analysis of the value of companies traded on the stock exchange? You need to protect yourself from the pitfalls of becoming an optimist or a pessimist. And there are 5 core principles that you need to follow for that. The first principle is to understand that a stock is not just a code of letters, the ticker on your phone or computer screen. Those little letters represent a real company with people working and generating an intrinsic value that is independent of the price of that share. The second principle is to get used to the idea that the stock market is a pendulum. This pendulum swings between exaggerated optimism, which makes the stock prices too expensive, and unwarranted pessimism, which make the prices of stocks too cheap. Your job is to buy stocks when they're cheap and sell them when they are expensive. Principle number 3 is to understand that the future value of any investment depends on its present price. So there's no use choosing the best company in the world if you pay too much to buy that stock. In any case, the higher the price you pay, the smaller room you have for your earnings. The fourth principle is to assume from the start that you cannot eliminate the risk of making mistakes. All you can do is to reduce this risk by always keeping a margin of safety. That is, never pay too high a price when you buy a stock. And the fifth principle is to understand that the secret to your financial success depends on yourself. You need to acquire knowledge, take responsibility, and not believe the news and the opinions of others. The behavior of your investments is far less important than your own behavior. There are two types of investors. You need to define what your profile is before you start investing. There is a difference between speculators and investors. An investment operation is one that, after a thorough analysis, promises security of the amount invested and an adequate return. All operations that don't meet these conditions are speculative. Speculators are on the stock exchange as if it were a casino. They buy and sell stocks on the same day, perform day trading. They operate leveraged betting using money that they don't have, making decisions just looking at charts without caring about the company's fundamentals. Investors are those who are on the stock exchange with the aim of becoming partners in good companies, investing in real businesses to make a profit. The book deals only with investors and does not focus on speculators. Investors are divided into two types: the defensive investor and the enterprising investor. The defensive investor is where most people fit in. You can think of someone who has a profession, someone who has a source of income from his work, but who wants to invest part of what they earn to increase their wealth. This person is not following the stock market daily and is unable to make decisions frequently. Therefore, the main role of a defensive investor is to avoid serious losses or mistakes. The enterprising investor spends much more time and care in choosing stocks that are safe and more attractive than the average. As a reward, they can make a little more profit than the defensive investor. Before you start investing in the stock market, you need to decide whether you are going to be a speculator or an investor. If you choose to be a speculator, this book won't do you much good. Now, if you choose to be an investor, you must choose between being a defensive investor or an aggressive investor. These initial definitions are very important for you to follow a coherent strategy and not make mistakes that can cost you a good part of your wealth. To increase your chances of buying low and selling high, do rebalancing and good asset allocation. We will explain everything in an easy to understand way. There are two major classes of investment that you can put your money into. These are fixed income, generally bonds, and variable income, generally stocks. They are assets, specifically financial assets. Fixed income is less risky, but it doesn't bring great returns. Now, the variable income is riskier, but it also has more income opportunities. So as an investor, you need to know how you're going to be distributing your money. What part will you leave in fixed income and what part will you leave in variable income? This is called asset allocation. For example, imagine that you decided to allocate half of your money in each one of these classes, 50% in fixed income and 50% in variable income. You can even imagine like two equally sized buckets that represent your money allocated to each one of these assets. So if you had 10 grand to invest, you leave 5,000 in fixed income and 5,000 in variable income. You can imagine each one of these two buckets with values equivalent to 5,000 each. Now, the problem is that over time, this allocated money will change proportions. It depends on how much money each one of them will yield or even lose value. So in addition to deciding what your initial allocation will be, you also need to define a certain margin of variation that you can tolerate. For example, plus or minus 20% of margin. Continuing our example, imagine that after a while your stocks have made you profit. The stocks are part of the variable income class. So if now you have a total of 20,000, what happened? Initially you had 10, so now your money has doubled. And when you look at the variable income bucket, you see that you have 14,000, and the fixed income has 6 grand. How much do your buckets now represent proportionally? You're right if you said that 14,000 is 70% of the 20,000, and 6,000 is 30% of 20,000. Do you notice that the proportion is now different? At the beginning, you had defined that you wanted to have 50% in fixed income and 50% in the variable income. And what happened is that the variable income, in our example, yielded so much that it changed the proportions. As in our example, we defined that our tolerance will be 20% more or less. Now it is time to rebalance, to restore the proportions. The technical name for this is rebalancing. Okay? So you can sell some of the stock right now and put more money in the fixed income bucket. This is in line with the main idea of the smart investor, that after all you're selling for a higher price than what you bought. This is the simplest possible explanation. Now we go on with the detail. The hardest part is selecting the assets that belong to each one of these classes. What fixed income assets are you going to buy? What stocks are you going to choose? Will variable income have only stocks, but also REITs, funds, options? This intra-class selection should follow the idea of diversification and also the average price formation. Diversify your investments and bet on the strategy of forming a discounted average price. The defensive investor should focus on buying shares in leading companies with a proven track record of profitability and that are in healthy financial condition. Caution: the defensive investor has to be conservative, should not venture into trendy companies, hype, and growth companies. When a company is very new, it is usually loaded with debt in order to grow. And its price is very expensive because the market expects that it will make a profit in the future. But this is uncertain. Instead, the defensive investor should stick with companies that have proven to be profitable over the years and have solid foundations. On the other hand, the enterprising investor doesn't have this type of limitation. As an investor who will spend many more hours every day studying the market, the enterprising investor can buy also other types of stocks. But they must be chosen after an intelligent analysis. The right way to choose a stock is by going to the company's website, downloading the balance sheets that they are required to be publishing to disclosing, and studying the indicators that are presented one by one. Only from this analysis you can define whether the company has good fundamentals and whether the current share price is cheap or expensive considering these fundamentals. Also, there are some steps that you can take to reduce your chances of making a mistake. First, you must diversify. You must choose several sectors of industries, and within these sectors you can choose more than one company. A diversified portfolio should have between 10 to 30 stocks. Second, you can choose to buy mutual funds that choose stocks or simply follow a predefined stock index. Third, you must consider current inflation, economic conditions, and the future prospects of the place where you live. Whenever analyzing whether a stock is growing, you have to remember to differentiate between real growth, inflationary growth, and speculative growth. And finally, you can bet on the average cost tactic to invest the same amount each month in the chosen stock. And then you form an average price that is discounted in the relation to the fundamentals you analyzed. This is the simplest strategy, and it is one that can prove to be a winner in the long run, which in the stock market means 20 years. We have already explained in detail the average price technique, the DCA, dollar cost average, in the episode number 8 of the Money Arata series. Basically, you choose the assets, you define the percentages of each one that you want, and each month you invest part of your income to reach these percentages. If any asset appreciates a lot in relation to others, exceeding the maximum limit of the defined percentage, you can rebalance it. You can sell high and reallocate to assets that are below the percentage, thus buying low. And when you're doing this, remember that stocks, the tickers, they're not just codes on your computer screen. There is a real company behind that code, that ticker. There are real people working in a real business. And in the real world, companies usually grow slowly over the years with some ups and downs. Don't keep trying to time the market. Instead, focus on the relationship between stock value and price. The market swings like a pendulum. Sometimes we are in a bull market, sometimes we are in a bear market. These names come from the analogy with animals. The bull's horn throws you up, that's the bull market. The bear's paw that throws you down is the bear market. This pendulum swing brings opportunities for the investor to profit. There are two ways to profit from the swing: the market anticipation path, called timing, and the pricing path, that is the pricing. Timing is the effort that the investor has to make in order to anticipate the movements of the stock market. He has to get the right timing to buy and hold an investment right when future developments are considered to be upwards. And he has to set the timing to sell or not to buy when future developments are considered to be downwards. On the other hand, pricing is the investor's effort to buy shares when they're quoted below the value considered fair and sell those shares when they're above the right value. The definition of fair value can only be done through an analysis of the company's fundamentals. As you can imagine, pricing is the recommended strategy for the smart investor, for the intelligent investor, if you keep trying to get the timing of the market right, in a sense of wanting to predict when the stock will rise or drop. You'll end up acting like a speculator and you have the financial results of a speculator, always thinking about the short term. For the smart investor, day-to-day or month-to-month fluctuations are not so important. The important thing is the long-term result. The biggest effect that oscillations have is to make the intelligent investor go against the market, that is, buying when everyone is selling and selling when everybody is buying. It may seem contradictory, but a serious investor is even happy when the price of the share falls, as long as the value of the company remains. When this happens, it is like you're facing a promotion in a store. You can buy a good product at a discounted price. It is like you could buy $1 bill for 50 cents. To do this, the investor needs to cover his ears and never listen to a dangerous entity called Mr. Market. Never let Mr. Market define the way you handle your money. When you invest intelligently, you're not putting your money in a code of random letters, the ticker of the stock. You're actually buying part of a company. Imagine, for example, that you studied and after a lot of analysis, you understood that it made sense to invest $1,000 in a particular company. Now imagine that someone knocks on your door. This is Mr. Market, an imaginary character who helps us to understand the difference between value and price. Mr. Market is constantly making you proposals for you to sell your stock in that company to him. He's a manic depressive. There are times when Mr. Market is euphoric and optimistic, and there are also times when he's feeling completely defeated and pessimistic. So even though you bought your share of a company for $1,000 because you understood that this was the right price, sometimes Mr. Market offers you the price of $1,500. Sometimes he offers you only $700. In addition to him trying to buy your stock at those prices, he also offers you the possibility to buy from him at same prices. And that is why it is important for you to have your own opinion and not be influenced by Mr. Market. The value of a company, its fundamentals, they hardly change from one day to the next. What changes is the price. This price change provides you an opportunity to buy when the price goes too low and to sell and make a profit when the price goes too high. For this, you need to have a clear definition of the fair value of that stock. Apart from this opportunity, the best thing you can do is to simply cover your ears, don't listen to what Mr. Market says, and continue focusing on analyzing the fundamentals of good companies so you can set a fair price and thus be able to buy more and more shares of good companies at discounted prices. Even in a bull market, there are always individual stocks that are selling for prices that are below what they are worth. The people who follow Mr. Market's tips are the ones who buy when stocks are going up, pay more than they're worth, and they sell out of desperation when the stocks are falling. They're getting less than the true value of that stock. You, as an individual investor, have more freedom of choice than a professional investor who has to comply with certain rules that are determined in advance. The professional investor needs to be accountable, and therefore they tend to make choices that follow Mr. Market. However, you don't have this obligation. Pay attention and you can identify opportunities to buy low and sell high. Mr. Market's job is to provide prices. Your job is to decide whether it is advantageous for you to buy or sell based on these prices. It is essential to understand and use a margin of safety in your investments. There is no easy and guaranteed way to make money on the stock market. Avoid looking for formulas, foolproof techniques, or technical indicators to place your chart as buy and sell signals. Having made this clarification, there is a concept that can make a huge difference to your investments. That is the concept of the margin of safety. Imagine that you are an engineer. You need to calculate how much weight an elevator needs to support. If the elevator is for a maximum of 4 people, 100 kilos each, would you make an elevator that has cables that break with a weight of more than 400 kilos? Obviously not, that would be too risky. Maybe you plan for some elevator that can hold twice as much, 800 kilos. Or if you're more conservative, maybe even more than that. This is the idea behind the margin of safety concept. In the investment world, you can, for example, use the margin of safety to calculate whether it makes sense for you to invest in fixed income, buying the debt of a company, of a security, or even variable income, buying shares of a company. Fixed income corporate bonds are basically the company saying that it needs to borrow money from you. It promises to pay you back with some interest. But there is a certain risk involved. How are you going to decide whether it makes sense to be lending money to this company? You can, for example, examine the ratio of assets to liabilities. Compare Company A and Company B. Company A is a company with lots of machinery, land, and product inventory. It's totaling $10 million, and it has obligations and debt of only $1 million. Now, Company B also has $10 million in assets, but it has obligations of $5 million. If all conditions are the same, well, Company A has a greater margin of security, of safety than Company B. Another example. Now think of Company C, which makes bricks, has been in existence for over 30 years, and in the last 10 years it has been profitable, has paid out generous dividends. It is growing steadily. Now, Company D is a food delivery app. It is a company that only has 5 years old. And in these 5 years that it has existed, it has never made a profit. It is a startup being financed by several investors, and it is in debt, and every month it closes on the negative because its objective is to grow, to expand. However, in fact, it is losing market share because other companies are offering similar apps. They are competitors. Now, in this case, Company C has a greater margin of safety than Company D. The margin of safety is what gives you a comfortable space to protect yourself in case you're wrong in your investment decision. And in case you're right, a good margin of safety even increases your profit. Therefore, in investments, the idea of a margin of safety is always dependent on the price you pay. Even if you find a great company to invest in, you won't be able to get a good return if you pay too high a price for that stock. If you have all your eggs in one basket, you have less of a margin of safety than diversifying. No single stock can guarantee you a good margin of safety. The safety margin of a stock alone only guarantees that it was going to be more likely to make a profit than a loss, but it doesn't guarantee that such a loss is impossible. That's why you need to diversify your portfolio by investing in several stocks from different sectors. As the number of assets with a margin of safety increases in the portfolio, the more confidence you have that total profit will exceed total losses. A smart investment needs a true safety margin, and a true safety margin is one that can be demonstrated by numbers, by reasoning, and references to real experiences. It is the same as when you run a real company. Operations that aim for profit must be based not on guesswork, but on data, on mathematics. Ensuring that you won't lose more than what you win is the first and most important thing you can do. By refusing to overpay for your investment, you minimize the chances that your wealth will suddenly be destroyed. Keeping your portfolio diversified and paying a discounted price on the shares of good companies, refusing to pay high on the latest trends from Mr. Market, well, then you can guarantee a return higher than the market average and thus see your equity increase like a snowball over time. Making money on the stock market in the long run depends more on you than on the market. Only by understanding how to correctly evaluate publicly traded companies will you be able to trade at a profit. This way, you'll be able to understand the difference in value and price. It sounds simple, but it is not. If it were, everyone who enters the stock market would already be rich. This doesn't happen because knowing how to analyze and choose a stock is something that requires study and patience and practice. For you to know what your investor style is and use safe strategies with protection and mathematical calculations to make profits, you can take our training, and there is a class available for you to start right now by visiting arata.se/truly wealthy.